G'day folks, welcome back to another update for the S&P500 and the NASDAQ. Now both are consolidating at the moment. We're going to include some back testing and look at Fibonacci levels as well. Also hit that like and subscribe button to support the channel, and also reference the +1 videos where we look at a deeper dive into some trading strategies which we may gloss over in today's videos. Now in terms of the outlook for the S&P, both the S&P 500 and the NASDAQ are currently supported by strong corporate earnings and the ongoing technology AI investment theme offering a favourable risk on stance. However, this positive backdrop is underpinned by a complex and fragile macro geopolitical environment, tensions between the US and China, especially around tech and exports, Middle East energy dynamics, domestic US fiscal policy risks, and global growth slowdowns are all lurking as potential disruptors. In short, markets are advancing but should not be viewed as immune to shocks. So starting with the S&P 500 on the weekly chart first, we look at the long-term trends, and the price is well above the moving average. They're giving us a nice bullish momentum at the moment on the weekly, but do notice we've got this lower highs on the CCI versus that period back there, and that's a bearish divergence. Now the CCI has actually pulled back into that very narrow moving average range, and I like to use moving averages here just as a bit of a tip. Notice here, for example, the consolidation of the price during that little period. Even though it did eventually break higher, we had a consolidation and tightening of the moving averages. I'd like to see the moving averages widen like they are at the moment and giving us a more bullish environment, and versus back here when it was dropping. So these moving average, multiple moving averages are giving us that signal. So at the moment, bullish, but just be cautious. We've got this bearish divergence and it's currently on that moving average range. On the daily, we've actually hit this resistance up here and we're currently broken below the moving average range. Now you'll notice if that keeps falling, that moving average range will tighten. The CCI is already broken to the downside and also is below the moving average range, giving us a bearish outlook at the moment on the daily. So avoid trading long at the moment if you're looking at trading on the daily or even the intraday time frame. Just a bit of a tip, we do cover some history in terms of the bearish divergence and bullish divergence. Going back to here to 2008 with the financial crisis, we had a bearish divergence and eventually we had a bullish divergence and it started rising. Back here we had the China slowdown, a very small one, and here we had the COVID-19 crash, and here we had the 2022 inflation and Fed tightening, and here we had more recently another drawdown and bearish divergence which we showed. So again, always follow the bearish divergence indications for any potential reversal. Now looking at the 1 hour chart, we've got the price below the moving average, and so is the CCI is broken into that moving average range. So if you are going short, I like to take profits when the CCI breaks into that moving average range. You can see there it's near the bottom, rather than waiting for the price to make further upside towards this moving average range. That's my preferred exit strategy because that maximizes your returns. You can see if you got in at the top there on that candle, you would have ridden that little wave right down to that candle there and gotten out right near the bottom. The other thing to consider here is there's no divergence currently on this CCI and price movement. However, I'm going to draw a Fibonacci level here. It's always worth looking at Fibonacci levels because sometimes that gives you indication of where it may potentially reverse. Here, for example, we've got a Fibonacci of 61%, which is a key area in Fibonacci rules, and it's actually bounced perfectly off that 61%. So I'm not saying it's going to reverse from here. Don't go placing long orders, but just something to be mindful of as we track the charts. Back here we had a bullish divergence, higher lows versus lower lows on the price, and that hit our minimum target. And in that little range, if I draw a Fibonacci, that went as high as the around about the 50% level before pulling back down again. So these Fibonacci levels don't necessarily mean reversal, it just could mean a slight retrace. And lastly, if you're trading on the 1 hour time frame, you go in accordance with the daily trend. So going back here, I've drawn a little arrow there showing where you would have started going long, and you would not have gone short during any one of those periods, even though we did have a bit of a break below. So the way that looks on the 1 hour time period on the back test, this goes back to around late August. So you can see there we've had a few little drawdowns. And the way to avoid those is whenever you see the price and the moving average range of the CCI start to turn down like they did here, you'd get out of the trade. So you would have got out there holding probably at 1 or 2 contracts, and that would have avoided that little drawdown. Otherwise, you let it go. Again, always following any bearish divergence to look out for. Like again, another exit point there. But also notice here we had a bearish divergence during that little period. Avoid going short, going long again there, probably closing it out around that point there. Going long, look out for it. This is so the price keeps rising there. Notice the CCI drops, and as soon as that you see that divergence complete, you get out. You possibly could have gotten out there, or if you held on to it again with holding a couple of contracts. So the idea is you want to average down, let it give it time to breathe, let it rise, but always follow the trends of the CCI and the price, and get out to avoid any massive drawdown. Again, the more recent one here, getting out of it there, a little bit of a divergence there. I've zoomed out deliberately here so you can see the moving averages rather than the price bars. So getting out there, avoid this little downfall, maybe do a couple of little short, long trades there, but also again making sure the daily's in an uptrend. And if I zoom in again, you can see there you would have got out the very latest, probably somewhere around that period there, and avoid entering at that point there. Even though notice there also the moving average band and the CCI were in decline, so ideally you would not have entered that position there. So the NASDAQ on the weekly is also bullish, well above the moving averages, and the CCI is pulled back towards that moving average range. So again, caution to be taken. There's no divergence currently on that range there. On the daily, similar to the S&P, that's broken below the moving average range on both the price and the CCI. So again, avoid taking long trades if you're trading on the intraday. And I'd like to see this break higher before starting to take long trades again, especially the CCI breaking above as well. Now, there's no divergence currently showing there. And this is the daily chart. And yeah, there's nothing happening at the moment. That was a bearish divergence there. And that could still possibly, that's actually been invalidated because that high is broken, that previous high there. So there's no more bearish divergence yet in play. So I'm going to remove that target range. On the 1 hour time period, again, similar to the S&P, both the price and the CCI broken below. Again, if you had it gone short at that point there on that candle, ideally I would have taken an exit probably on that candle there, right near the bottom, and that avoids you holding onto it. Now, of course, the price could continue to drop, but then I'll just enter a new trade if that price remained below the moving average and a CCI had a fresh breakout to the downside. So that's how I'd enter a new trade. Back here we had a bullish divergence, higher lows versus lower lows. Now this one seemed it did hit the target. So if we drew a Fibonacci to that significant high, you can see that it broke up very quickly, that 23-38% range. That's our minimum target, and this time it went up to the 61%. So again, follow those Fibonacci's are very, they're not always predictive, but it gives you an indication where potentially it may reverse or retrace. Here it retraced off that 61% further to the downside. So again, we can't predict that necessarily, but Fibonacci's do have a habit of giving you some indication of potentially where they're going. Now in terms of the back test, if you're trading on the hourly, I've got the back test here. Again, it would have been going predominantly long throughout the whole period according to the daily. Similar sort of routine, you follow the movements to the upside on the price and also the CCI. Look out for any divergence. In this case, let it run. See there, even though the CCI has dropped off, giving you a couple of bearish divergence. This first one seemed to fail. Actually, it's pretty hard to read from here, but yeah, that one failed to hit its target. So what you do is let it run, stay in the game, and average down where you want to average down in terms of your price reduction, and then wait for another bearish divergence or the price reversing on and the CCI reversing like it did at that point there, and you would have got out of the trade. So you would have had a nice little gain there. Again, avoid going long during this period, going long in that little area and closing it out when both the price and the CCI drop, maybe holding a contract or two open there, avoiding that drawdown, and so on. Where we are at the moment, again, you would have closed out at the very latest somewhere around that point there. Now notice here the CCI and the price moving averages started to decline. That could have been an entry point there, but you would have closed it out very quickly with maybe a small gain or a small profit or a small loss on that little trade. Again, notice the overall trend is in a downturn on the price. So again, we can't tell how far it's going to drop. We always follow the daily. So that period there, for example, should you have gone long there, that's a 6th of November. Let's go back to the daily. 6th of November was back. This is the, let's go to the daily. 6th of November, that was back here. And what do you see? You see the price still above the moving average band or just touching it, but the CCI's dropped below. So you would have avoided going long during that period. So ideally, you would have stopped going long on that candle there on the daily. So you would have stopped taking long trades on the hourly. And possibly, I wouldn't have, actually, you can take some short trades during this little period, but I like to wait for the moving average band to turn down as well. That could have been a potentially false break there. But again, that's there the chance you take. What you're looking for is a continuation. And most of this year actually has been in a bull run. It's still in that way. This could be a start of a reversal, but again, too early to say because I'd like to see the moving average band on the price also start to bend down before being more confident of a bearish environment. Also, if you'd like to get some insight into some share trading ideas, we do a weekly bullish scan for our Patreon subscribers, and these are some of the trades we've taken since the 21st of September this year. These are all closed trades, and in terms of percentage returns, in just over a month, we've returned 11.91% return. So again, if you'd like to get access to that scan, subscribe to the Patreon page, links in the description below. Hit that like and subscribe button to support the channel. Thanks for watching, and see you in an update.